Welcome to the B.F. Anderson Technical Report for March the 3rd. This chart is interesting. It basically shows what stocks tend to do after corrections. They tend to do well. So we are in a correction, call it a bear market, could call it just a bad market, could call it a bird market. It's just for the birds. It's not a good market. So here are your correction returns starting in 1980. And you may want to pause your video player just to kind of see the damage that is done during these corrections. But what's interesting is 1 year later, after you make the lows in the correction, the average return for the S&P has been 24.8% after 1 year. 2 years later, 37.4%. So corrections are bad, not fun. However, there will be a recovery. Now, this was also interesting. This is showing invasions of, war activity. And again, you may want to pause your video player, but like the Vietnam War, what happened if you bought at the time of the invasion, the Gulf War, the Afghanistan War, a little different, Iraq War, and Crimean crisis. So basically the purpose of this is just to say, hey, sometimes these things don't turn out to be as big a deal as we thought. However, I will say Russia is a nuclear power invading another country. This could be quite different. Market's not reflecting anything other than a downtrend. As you can see here, Nasdaq in a downtrend, came down, made a major low on February 24th, and then rallied, failed to break out. That is on the Nasdaq. Now on the weekly graph, we continue to be in a downtrend on a weekly basis. You can see here 35-week moving average rolling over. Here we have the 400, the S&P 400, which is the mid-cap stocks. Again, we're trying to consolidate. In fact, we got somewhat of a W formation here. If we could resolve to the upside, that would be very positive. New York Stock Exchange, all the stocks on the New York Stock Exchange, a lot of banks, a lot of oil companies, however, continues to be in a downtrend. S&P 500, S&P 600 small cap. The small caps really never did rally, and so as a result, we're seeing somewhat of a flattening out here, which basically is a good sign. The S&P large cap, again, same story. We continue in a downtrend. On the weekly basis, continue below the 35-week moving average. Continues to be difficult. This is not a bull market. This is a difficult period. Now, we're going to talk a little bit at the end of the video about the aggression index. Now, this index was invented by my friend Mike Santello with Cabot Research. It's a very simple calculation. We're just calculating the relationship between technology stocks and consumer staple stocks. Consumer staples, we all know, toilet paper, toothpaste, beer, Cokes, that kind of thing. So if you think like an institutional investor, you go, I'm seeing trouble ahead. Most institutional investors have to stay invested all the time, so they just start shifting their portfolio into more defensive areas. You could do this ratio with things like utility stocks even. But the point is, when the line's going down like this in a downtrend, it's telling you this is not a good time to be speculating or aggressive. So the aggressive index we'll talk more about. Now on the yield curve, you can see here we continue to flatten out. The spread is about 0.41 right now between the 10-year Treasury and the 2-year Treasury. We don't want to see an inversion. That would be a sign of inflation, but it is heading in the wrong direction. 3 economic indicators we keep an eye on. Interest rates are very interesting right now. They're dropping, and I think it's basically because a lot of people are panicking out of the stock market and putting their money into bonds, and that's driving interest rates lower. We're at 1.8 on the 10-year Treasury. You can see here oil spiking. Actually, this morning it hit 112 per barrel. Now, one thing to understand about oil, at some point, demand will fall off because the pricing is too high. Financial stocks, along with interest rates, in a downtrend. New lows continue to be too high. We had 133 yesterday. However, you can see that we're just kind of getting a whole bunch of new lows on the New York Stock Exchange. It's not a positive sign. Here we have the bull-bear ratio. Now, this is a positive. I mean, we're seeing a lot of pessimism here. Now, remember, this particular sentiment survey is updated every Thursday. So it'll be updated, but as you can see, we're basically in record territory for pessimism, which is what you want. You don't want to be investing in the stock market when everybody and their brothers kicking their heels. You want to do it when things are pessimistic, but you got to be patient and wait for the right time. Now, on the put-call ratio, you can see here we've been seeing some put buying, which is institutional money. The thing about this particular sentiment reading is this is where people are putting money. This isn't a survey. This is where people are actually doing with their money. Now, here we have the percent of stocks above the New York Stock Exchange stocks above their 200-day moving average continuing to deteriorate. We got below 50%. We tried to rally a little bit, continues to come down. Now here's the Nasdaq, same calculation, percent of stocks above 200-day, still below 25. So that means 75% of the stocks on the Nasdaq are below their 200-day moving average, which just is not the kind of thing we're looking for. Hopefully it does resolve. Trend strength, this is our new indicator where we're using 7 moving averages. You can see here where the moving averages are all starting to get real crossed up. That's not good. We have a trend strength of 0 on the Nasdaq. Now on the S&P 500, same story. Came down, made a low, failed to really break out in any meaningful way. So we are in a downtrend here after a double top. Trend strength is 0. Now on the volatility index, we're starting to see somewhat of an uptrend there. So volatility is increasing. It's not getting exorbitant because, over 10 days, you tend to see over 10 days if the VIX goes up by 50% in a 10-day period, that tends to be a peak in volatility. Well, right now we're at 24.2, and the particular VIX is in an uptrend. Now on the aggression index, I went back and did a little back studying. And this is the year 2000. This is the 2000 bear market. So down here you can see the actual S&P 500, which was basically making a high and holding steady, but we were getting a sell signal on the aggression index as it broke below that 40-week moving average. Now what was also interesting is we made the low in October of 02. The market really didn't take off until 03, but we started getting a buy signal. So basically what's happening here, institutions move in and out of these consumer stocks, these defensive stocks, and you need to keep an eye on that. Now here is the year 2008, 2009, the great financial crisis. You can see here, major break in the aggression index. Don't be aggressive. Market's making a high. It starts to tank. However, we then get a buy signal in early 09, which was around March of 09. So this particular indicator is very, very handy, and we have found it to be very successful. Now, here's where it is now. The aggression index, and just to remind you, we saw it earlier, but it's in a downtrend. I would continue to keep my powder dry. Here's top 5. We're seeing some real interesting stuff in the commodity areas. This is fertilizer. This is CF Industries making an all-time new high. Lots of volume coming in. If you're gonna nibble on something, this is the kind of thing you might want to look at. Now here's Devon Energy. As we all know, price of oil up. As a result, the oil stocks are breaking out. Now I'm just kind of hesitant about oil at this time. However, Intracellular Therapies, which is a pharmaceutical company, announced earnings yesterday. Somewhat gapped up on the earnings announcement. However, we're not getting that convincing volume. We're just not seeing, above average volume on this breakout. So I would continue to watch. Marathon Oil, you can see again, the oil stocks stay in an uptrend. Volume is constructive. And then last but not least, Occidental Petroleum literally taking off, smoke up a chimney. Looks very positive. Oil stocks continue to be positive. However, I have found this group of investments a very difficult group, so please be careful. If you have any questions, please let me know.